Hey, welcome to the NZ Everyday Investor. Investing, it's something we should all be doing if we can. But why? Well, if you don't invest, if you don't try to grow your base of wealth, it could actually be taken away from you. Inflation will attack and erode your value that you currently have stored up over time. Purchasing power decreases with inflation. Investing in assets which grow in price over time, hopefully above the rate of inflation and after fees, is the antidote for inflation. Investing, though, involves risk. Risk that what you invest could go down in price instead of up, and risk that you may not be able to get your money out in a hurry if you need it. Now, if you've decided to invest or to grow your base of wealth, here are 3 things to keep in mind, or 3 golden rules. Number 1, invest regularly. This is so important. Timing the market where you buy low and you sell high is great, perhaps for some, but for most of us, we can't actually get the timing right. Dollar cost averaging is the best way to consistently scale in over time to get the exposure that you want without getting the timing piece perfect. Number 2, getting your asset allocation right. A good portfolio or collection of investments will have the following ingredients inside of it: cash, fixed interest like bonds or term deposits, property, and shares or equities. The mix or blend of these different asset classes is crucial to strike the right balance between liquidity, or the ability to convert your investment into cash quickly, and risk, which is the possibility that the price of your investment could drop, and returns, which is your compensation for risk and liquidity. The third thing is really important. Start with the end in mind. Now, some of us view the whole investing thing as a game to win, but there's so much more to it. What is it that you're actually trying to achieve? Now, have you factored in how much you actually need to live off of in the life that you're aiming for in retirement? What about your kids? What about your family and your parents? What are you going to do with your home in retirement? Plus, how long do you think you're actually going to live for? These are all some of the questions that can help set the appropriate amount that you need to set aside from today for tomorrow to be taken care of properly. In today's episode, I'm talking with David Boyle from Mint Asset Management. The hunt for yield is our topic. In an environment where interest rates are super low and there's a significant disconnect between Main Street and Wall Street, how can investors still do well without losing everything? I hope that you enjoyed today's episode, and if you do, please be sure to like and subscribe to the NZ Everyday Investor for more content in the future. Hope you enjoy. Awesome. Welcome to the NZ Everyday Investor. I'm your host, Darcy Ungaro, and I am in the studio today with David Boyle. Welcome, David.
Hey, Darcy. How are you?
Cool. I'm good, thank you. I'm good. So, David, for our listeners, I'll introduce you, I guess, as the guy from Mint Asset Management.
Correct.
And also, formerly, you were with the Commission for Financial Capability as the head of investor education.
That's right.
Did I get that right?
Yep. No, absolutely. Spent about 4 years at the Commission there, focusing on all things to do with money and retirement, kind of bridging the gap between paid income and investment income.
And I think it's really important, that we have this connection between these government initiatives plus also private enterprise, and have a bit more of a handshake so that we can kind of work together as a team to grow stuff.
Yeah, look, absolutely. As an industry, we're all responsible to actually improve investor education. So it's a pretty boring topic when you're a punter on the street, but actually it's so important if you can get a little bit of a good foundation and plan in place to make a difference in the long term. And I guess that's what we'll talk about today.
Yeah. Well, let's get started with, I guess, the starting question, which is, why do we invest, or why should we even bother with investing?
It's a big question. It's a simple one though, is because I always quote the book, The Richest Man in Babylon. I mean, well before many people are around. I mean, it was written in tablets of stone, essentially, to pay yourself forward, essentially just save 10% of your income, or to pay forward that time when you're not going to be able to work. Now, it was pretty good in those days because I guess the longevity age was maybe 40 or 50 if you're lucky. Where now, my mum's 93. and still goes out dancing a little bit. So our longevity is great, but it means that we need to pay ourselves forward even more. And I guess things like KiwiSaver and saving on top of that is going to be more important as we get older.
Gotcha. So it's kind of like, why invest? Well, you have to. You kind of have to, right?
You do. I mean, you can keep borrowing it, but someone's going to have to pay it back. And the key, I guess, is making sure that you have a plan to work out essentially what you might like in retirement. There's plenty of good tools, but you've got to have an inclination to do that. And I would have thought after COVID-19 and the impact that we've had, and we're seeing the ramifications of that running through our country and globally, that there's never a time to actually now sit down and work out what you really do need to do when an event like this happens.
Yeah, a bit of a wake up call or
it's not finger wagging. I mean, it's easy for us to do that in the industry and sort of told you so that, you do need this emergency savings. But at the end of the day, you've got to make hay while the sun shines. There's a lot of analogies that you could throw out there.
Yeah.
When you're earning, you don't spend all that you earn. If you can save a little bit more as you go, then that will start working and earning for you. And in time, you'll not only be able to have an asset that you can get some income from, but you'll have something that you can draw down, because most likely we have to accept that we're going to have to start eating our money along the way as well.
Yeah, we'll get into that for sure. So and you've touched on a couple of really key points. So The Richest Man in Babylon, if you haven't read it, that's an awesome place to start. The idea that 10% is a great, and we love these little reference points, don't we? 10% is a great sort of general rule of thumb if you were only living to like 40 or 50, but now you double that. So I guess my next question leading off the back of that is, hey, is saving 3 or 6% if you include employer contributions, if you're fortunate enough to have an employer, if you have 6% going in, is that actually enough?
Look, it's a good start. And we say we're only saving 3%, but you're quite right. I mean, for most New Zealanders that are on a salary, and most employers have to pay on top of, unless it's been negotiated otherwise. So you are saving 6%. To me, you need to pop another 4 or more over time, if you can, into something that's probably similar but not locked in through KiwiSaver, because there's no point locking more of your money away in the event that an emergency like this happened, or your circumstances in life changed and you needed access. I always think a bit of a mix with KiwiSaver, but don't just tick the box and do 3. Get the maximum benefits through the member tax credit and your matching employer contribution, and from there on, it's more about, well, what other forms of investment could I look at that would help me get to a place that I feel more comfortable when I stop work, whenever that might be, because we're living longer, we're actually going to be working longer. I don't think I'm going to retire at 65. I don't know about you, but I probably won't be working 4 days or 5 days a week. It might be 3 days, but I could do that, and I hope I could contribute longer, but in the industry that I'm in, and I'm sure others can as well.
I guess it's like, and of course, none of this is financial advice, but you've got your base level with KiwiSaver. It's good that it's kind of locked in for some of us.
Yes.
Because then we can't pull it out. But for others, it doesn't really make any sense locking up all your money in what otherwise should be a very liquid type of thing to pull out.
That's right. And look, the other things that are really interesting at the moment, because we're in an incredibly low interest rate environment, a lot of New Zealanders have got money in bank deposits and have got money in funds that are quite low risk. The unfortunate thing is that the returns are very low as well. And it's about managing the balance, if you like, of certainty of getting your capital back to a little bit of uncertainty of fluctuation of capital and that income coming in. And I think that's something I'm a little bit worried about as we will go deeper into this recession. I suspect that'll occur over the next 6 months or so.
So let's talk about the problem, I guess. So the problem is that we're all being forced as investors to hunt for yield, where maybe we weren't really hunting for it so much before. We were comfortable to drive our investment decisions based on who we were, what our attitude towards risk was, what our investment horizon is. But now there's almost like this sense that we're being forced into taking more risk if we want to hang on to this paradigm of believing, I guess, that we can live off of our capital or the fruits of the capital,
yes,
rather than actually sabotage and consume the capital.
Yeah.
So talk to me about this whole hunt for yield thing, this dynamic that's at play right now.
Yeah, and it's been around for quite some time. I mean, I'm showing my age, but when I bought my first house back in 1988, mortgages were 18%, and then they went up to 22%. It was like, crikey. Term deposit rates were in the 20s as well.
Yeah.
The thing that was going on though was inflation was rampant, and you didn't see how it was eating away at your actual buying power, and that's what people need to look at. It's the buying power of the money that you got today. What will it be able to provide you?
That's right. We often forget inflation because it's been so low for so long. That
yes.
is an evil that we still need to be on guard against. Right?
And it's there, and it's something that will continue to eat away. Now, if you're finding that the investment that you have in a bank term deposit or in something that is low rate of return now, and I mean you're looking maybe 3.5%. I'm not sure for a year if you're lucky. You then need to think, well, if you want more than that, well, what are the risks that I want to take on to achieve that income or that capital growth? And what's scaring me a little bit is seeing quite high interest rates that look really appealing, but when you dig a little bit deeper under or look under the sheets a bit more, you'll see that actually, what are the risks you're taking to get that money back? And a really good example would be the credit crisis in 2008, right? I mean, in New Zealand, compared to any other country in the world, the impact that we had was not necessarily around the housing bubble, but it was around the finance bubble bursting.
Right. Yeah.
And people were investing in a company thinking it was safe, but unfortunately it wasn't.
We're talking about the finance company collapse of that era.
Yeah, it was. Yeah. And they were higher returns, obviously, than what, but because it was deemed to be a secured debenture, it all sounds good. We saw the FMA and the regulator come out and evolve from that process to actually deliver, I guess, a framework that allows investors to understand more what risk is.
Yeah, they would have been saying, well, hey, it's a secured debenture, right? It's giving me 1 or 2 percentages over what I'm getting at the term deposit. Hey, this is great. What's the difference? Sure, it's a company, it's not a bank. What could possibly go wrong? They're just lending it to high risk developers. Surely that's safe. Yeah. But I guess, and that kind of has kind of washed away, or most of it washed away. And everything is pushed, hit reset. But a lot of people lost their shirts in that, and that's a horrible bit of history here, right? But it highlights our point that as we hunt for yield, we're actually engaging with a lot more risk that we potentially don't understand.
Yeah, and look, that's why I'm such an advocate for getting advice. And New Zealanders don't really like paying for that, but I think an investment in time and effort and using someone's expertise, even for a short period of time, will help mitigate some of that risk, rather than seeing an ad in a magazine or on the internet offering these great rates. And then ultimately the answer is, well, how easy or how reliable is it they're going to get my capital back? And that's probably the things that we've been asked that question around, say, a diversified income fund, for example.
Actually, can I pause you there? Sorry, David. Just to go back a little bit on one point you made, just to play devil's advocate.
Yeah, sure.
Bit, because I obviously I'm biased, but I totally believe it's appropriate to get advice as well. But I'm just thinking, right, well, with some of those people that lost their shirts to these finance companies back then, they may have actually been dealing with a financial advisor back then.
And they were. And I guess that the thing there is that there was a demand both from the public to hunt a higher yield, and if they couldn't get it from their advisor, well, then they were going to go out and get it anyway. In part.
Good point. Yeah.
And I think, the risks weren't as apparent because the transparency of the companies that they were investing in wasn't probably as high as it could have been.
Sure.
Hence why the regulator kind of evolved since that to provide greater transparency. Yeah. But it's human nature to look for the return first, and then wonder what the risks are after that.
That's right.
Yeah, I think as an industry, we've learned a lot.
Yeah.
It would be a travesty if we saw that happen again.
Yeah. So take me through. I interrupted you.
So thinking about, some of our clients have been asking us, for example, around our diversified income fund, are we prepared to look at putting more riskier assets to generate that income? And the answer is no. We'll endeavor to provide the best income, but we want to manage and provide that certainty of comfort that the capital that they're investing over the medium term is going to still be there when they want it. So diversification is, probably everyone's heard it before, but it's, don't put all your eggs into one basket. And that was the other lesson learned through the credit crisis, for example, was a lot of investors put their money in different finance companies thinking they were spreading their risk. But ultimately, if you got money that you want to protect, and keep the capital, well, the bank is going to be the safest place, most likely, or government stock, but you're going to pay a premium for that safety, and that is a lower return.
One of the side effects of the rate of return dropping is that there's this pressure for, I guess, even fund managers to introduce more risk apart from investors, but even the fund managers might feel this pressure. Well, we have to be in that top 5 for our conservative fund. Therefore, we're going to kind of introduce a bit more risk and kind of break the rules that we set back then. Yeah,
look, no manager should break those rules, because they'll have a set terms and conditions, or basically a SIPO that has the rules around how you can invest. And for example, with our income fund, we can't go any more than 30% into equities, and that protects the investor as much as
can you break that down for me? So you mentioned the SIPA word, so just break us down. What does that mean?
Yeah, the statement of investment proposition, essentially. So it's really the rules around how the manager is going to manage your funds. And you'll see when you read a product disclosure statement, there will be a kind of a risk indicator, which will give the investor a sense of, over a 5-year rolling period, generally maybe 3, but I always think 5 years is a minimum you should look at. We'll give a level of kind of what the risks are around that particular investment. So if you're looking at the other end of the scale, that might be a growth fund that has 80% of your money in shares and property and only 20% in income, well, that's going to be a higher risk, but over the longer term will generate a better return, hopefully.
Hopefully, that's theory. As interest rates drop, the rate of return on a lot of these investment classes drop. So we've got cash, fixed interest, property, and equities. The rates of return generally on everything is dropping as people are moving up the risk spectrum. If they do, if they stay still and they accept these lower rates of return, the risk there is if they don't move, inflation will gobble you up. Or you'll have to actually consume your capital.
That's right. And I always think that, probably the best financial plan is that, when your final calling comes, that you've got no debt, but you've got no money as well. You kind of reach that zero-sum game at the end. So you
can't bring it with you, is what you're saying.
No, you can't take it. You definitely can't take it with you. Look, a lot of New Zealanders want to pass on wealth to the next generation. But I think that's becoming more challenging, because a lot of our younger generation coming through are finding it more difficult to even get into property or into housing. So, many New Zealanders are trying to help subsidize that, but at risk subsidizing their retirement income as well. So I think, there are, and a really good innovation that came out recently was in KiwiSaver annual statements. Your listeners and viewers will be seeing that now, that they'll see not only what their balance is, but what their future balance could be, and the income that it would provide while drawing it down to.
That was a recent change, wasn't it?
It was something that we'd worked with the FMA and CFFC to kind of bring to life an annual statement as one place that people could get an idea. Well, crikey, that's not enough for me.
That's right. $600 a week.
Maybe on top of my super,
but for a lot, it isn't. Therefore, what changes should I make today to actually make that work? Right?
And that's eating your capital, because if you are living longer, that means your investment can go longer as well. So probably, unless you're going to die at 65, you've got another 20 or 30 years. So that means, why not have some of that money working, some of it anyway, longer term, so you can maximize the market return as well.
And it'll get you even further. But it's not just about trying to grow that base of wealth through diversification and whatever, but it's also preserving the capital so that one day you can consume it. And people can bring it back to that, because I think we need to get really comfortable, right, with that whole idea of
of maybe not passing it to our kids.
Well, not as much.
Not as much.
Yeah.
Or if you want to help them, maybe you should actually consider helping them now to get started in their first home or whatever.
Yeah, when
that's it.
their education. I mean, that's not cheap.
True.
And it's a way that, obviously if that's a way, or getting them into a trade, anything that would help them get into the workforce quicker and to get in control of their own personal financial circumstances would be great. But it's not easy. And I think the concept of eating your investment once you've built it up is not an easy one. And it probably needs a bit of time. But the realization is, if you are going to live longer, you're most likely going to need to do that.
And that's okay.
It is actually okay.
It's weird though. Like, I know that just going through this lockdown period, talking to a few clients who were actually pretty well positioned, who had significant buffers, they had savings or available credit in their mortgage facility. It was still really hard for them to access it. They were really reluctant. Their rainy day fund, even though it was pouring rain outside, was still being kept aside for some other
another one
event.
I mean, you think of COVID-19 as an example. I mean, all the moons are aligned in the sense of what a global pandemic could actually do to people's circumstances. And I kind of liken it to seeing if we were told 3 months before what we were going into, you'd think it'd be more of a Tory billboard ad rather than being locked down, not going to work, basically closing the economy and our borders until such time as we eradicate it. So I think maybe the good thing that's come out of this, people have looked at their circumstances perhaps, and it'd be probably very quickly they'll go back to some level of normality. But I hope that there'll be a trigger that will get them to to use that as a catalyst for change as well.
Correct.
And just small changes. Not I'm making my lunch, I'm not buying lunch anymore. And I kind of worked out when I was at home what that cost really was. And it sounds trivial, but over a long period of time, it can make a big difference. It's
this weird balance, I guess, right, between taking care of your own household, which if you have more than one person in your household that you're responsible for, that is your job, is to take care of that household, and then being a member of the broader economy and spending money at your local cafe. And when is it appropriate to do one and the other? And there's all these kind of pressures and expectations, but really all I want is a freaking sandwich, right?
That's right. Look, it is. Again, it's about if you're able to see the impact of some of the changes in behavior that you make. And that was one of the things that really got me excited, was actually bringing it to life and seeing a plan looking forward, because I find it really hard to know what I'm going to be doing in a year's time or 5 years. How can our younger generations think about 40 years? I mean, it's a very difficult concept, but just chipping away a little bit and automating the process is a really good start. And that's, I keep going back to KiwiSaver. It's a great foundation, but use that foundation and process to then build your wealth relative to also enjoying the journey along the way as well.
Right. Yeah. And it's just about creating that buffer, creating that reserve, that cushion, creating resilience for later on. But we were talking before we pushed record just about, another idea of how you can actually, I guess, create and maintain and build a buffer right now.
The easiest thing that people can do, and we've found this with KiwiSaver, is once it's kind of coming out of your pay, it's like it's out of sight, out of mind. And it's only when you get an annual statement, you can start seeing this money build up. The problem for a lot of New Zealanders is that they can't start that habit, or in a position where financially they're unable to, and KiwiSaver is a little bit out of a number of New Zealanders' reach. The concept that I'm thinking about more is around how do we help New Zealanders get into that saving just a little bit, while also maybe connecting into KiwiSaver contributions later with their employer and the government, and having a buffer or sidecar account. It's not a new term. It's been around globally for some time, but you got to have a mechanism to make it really simple.
Right.
Anything that's easy to do, you'll find people will take on quite quickly. And the centralizing system that we have with Inland Revenue collecting KiwiSaver contributions, we could use that as a platform, I believe, as a mechanism to build this buffer and savings account. I don't know if you read a number of articles that are out, all saying why we need it, but no one's saying, well, how do we do it? And I think
that's right. And it makes sense. Like if there was some sort of, if every bank had a certain savings account which fed information on balances to the IRD, when it recognizes that it's too low, they start diverting some of your 3% to that account. And effectively, you're giving people the buffer they really need through that KiwiSaver mechanism, which probably takes the pressure off hardship withdrawals as well.
And we've seen that grown. And gosh, what a surprise not, because, people are being made redundant.
Yeah.
They are in financial difficulty. They've got this money in KiwiSaver. If they had a buffer as well as a KiwiSaver, that would help them leverage not to take out their long-term savings. But what would be worse? Not taking your money out, getting a high interest loan and compounding that impact, or putting your money on the credit card, which as well as I do, most are still around 19.5%, which is outrageous. In the real world, people New Zealanders are going to be challenged financially over the next, maybe the next year, actually, as the cascade effect of the economy starts to unwind a little bit. So, so where it's possible for New Zealanders to be able to save going forward, then this could be a option. It's not a silver bullet, but it's an option.
It's part of an overall thing.
Yeah, it's a discussion that needs to happen, I think.
Got it. Okay.
More than probably saying, oh, well, just take your money out of KiwiSaver. It's not the right answer.
No. So if we now, I guess, use that credit card analogy.
Yes.
You've got this horrible bad debt. You're paying probably 20% on the interest rate. Let's use that to bring it back to the discussion around this hunt for yield, where investors move up this risk spectrum. They're taking probably a lot more risk than what they're used to and what they understand. And they should actually be getting probably pretty close to what a credit card is in terms of the rate of return. Like they should actually be getting 20%. But really, they're just getting a couple of percent. They're getting ripped off, effectively, right?
Well, they certainly will be in a position that, relative to where they are today, would look attractive. Yeah. But, it's about getting your money back.
It's liquidity, isn't it?
Liquidity, or you're cashing it in. It is just, people don't think about that.
Take me through that example then. So let's say I saw something in the Herald offering me at the moment, let's say it was 5.5% return. It was a secured debenture. I put my money in, fantastic. Checks are just rolling in now, nice and secure, predictable. What's the problem with that?
There's nothing wrong with that. And if you're looking at a finance company, there aren't that many actually around now, but thinking around like property syndications, and you're putting your money into something
like an unlisted property fund.
That's right. Yep. And the running yields there, so you're getting that return. But it's actually, how do I get my money back out in the long term, or how easily is it accessible? And I think, it's not saying that it's necessarily bad, but you wouldn't want to put all your money into that, because if it is locked in, it's very hard to get your money out when you need it.
So you might be rewarded for the risk, but you're not being rewarded for the lack of liquidity.
That's right.
Yeah.
And that type of investment has its challenges around, people are wanting to get in, but also get out. And, how do you match that up?
Got it.
And I think that, you can invest in those assets more simply through the market, through equities, both in property securities as well as, New Zealand companies. And I think, we've seen a massive spike in New Zealanders investing online now, which I
wanted to talk about that. Yeah.
Which is incredulous, really. I was really blown away by it. And I thought, crikey, is this maybe helping with those that can't gamble because they're going out there and this is a nice hit, or fix to it. But
there's got to be, right? Like if you think about it,
I wonder
everybody getting the wage subsidy, they move back in with the parents. I don't know, but maybe they've got this money, nothing to lose, can't gamble. Let's open up an online saving, online trading account.
I'm sure there's an element of that. I'm sure that they would also be saying that the market has come down, and this might look like a good time to invest, which on the face of it is great. But I mean, it is a risk, and if it's something you've got to look at every day and manage and research. If you want to do well at it, and even that's challenging at the best.
Like I'm all for it, right? Like I think it's fat. Like, well, there's two minds, right? I'm all for it because it's increasing financial literacy. People becoming more comfortable with engaging with investing. That's awesome. But in the back of my head is this growing concern that 1987 consisted of a bunch of people getting really, really enthusiastic very quickly, And look what happened. And then it kind of burned it for a couple of decades after that. We don't want that.
No, you don't. The good thing is, again, the transparency and understanding of companies now compared to what they were like in 87 is far better.
Yeah.
But I'd be really worried if I started hearing that afternoon wine groups were coming back into vogue, and they were using that afternoon over a few beers of wine to find the next stock or share they want to invest in.
Well, I think it's lunch. It's lunch.
Is it lunch?
It's lunch now.
Is it
and
lunch?
It's happening in Facebook groups.
Wow.
That's the concern, right? But again, I'm thinking it's awesome. And
Yeah.
I'm also concerned at the same time. And it's a really weird thing because you can see it. The interest is really building. And in the US, with Robinhood, it's building big time as well. So you just got to wonder, well, people are starting to invest in bankrupt companies now, and it's going through the roof. What the heck's going on?
It's a funny time in the market, and there's a lot more to play out. But I guess we go back to the fundamentals, and I think New Zealanders, if they have got a little bit more time on their hands, that this is a time to look at not just what they're investing, but looking at the whole financial position and seeing what could they do that would help improve their overall well-being, and providing that certainty of a buffer right through to perhaps moving up the risk scale a little bit, to create some capital that you'll have when you need it.
Correct. Like if you did have over 10 years, I guess, and if you traditionally thought you were quite a conservative person, maybe it's time to have a conversation with somebody, or just have a real honest conversation with yourself that maybe it is actually time to take on board a bit more risk.
Yeah.
Right. So it's not always bad.
Absolutely. And I think a lot of New Zealanders look at, 65 is where my investment time horizon stops, because I probably won't be working. I know through some research that was done a few years ago that around 40% of New Zealanders work full or part-time up to the age of 70. So that means you've still got money coming in. So that means your money that you've got saved can actually be invested longer, because you aren't going to be drawing it down. So you can take a bit more risk with that. But we've seen risk, the volatility, God, that's a bit of jargon, but the way the markets have reacted with COVID-19, how I think it was March 23rd or 24th that it dropped 22-25% in some cases. The indexes were massive shocks, and we saw the behavior of some investors in KiwiSaver realizing that loss by saying, oh my goodness, I can't take it anymore, I'm going to move it into a conservative fund. And that means they've missed out on pretty much, we're back to where we were.
That's right.
Which is a little scary, to be honest, but it does highlight that you just need to hold on to your have a stronger constitution to volatility, because I think we're going to need to have that as the years go on.
I think so. And I think, chasing gains emotionally, getting excited when the market goes up, could often be a bit of a symptom or a warning that your behavior might not be appropriate when the market goes down again. Would that be a fair call?
It's very emotive. And, like I say, I'm not an authorized financial advisor. I can't give advice, but I think it's about understanding your comfort in risk. And people don't really understand that until they see their money go down. Right. It's all fine going up. And we've had a wonderful period of time, probably since even KiwiSaver started, even though we went through the credit crisis. It didn't impact a lot because the balances they were building up. So you're actually investing in a market going down, which meant that you're actually getting more bang for your buck. Yeah. Having a plan in place will really help.
Correct. Having a strategy, staying to the strategy.
Yep.
Don't change it.
No.
Maybe be comfortable with consuming the capital. Maybe be comfortable in some cases by taking higher risk.
Yes.
Understand what that means, though.
Yep. You combine all those together, and you're living longer, then you're going to probably enjoy living longer a lot more than you would be if you aren't putting a little bit away today.
Correct. Now, before we finish up on this, so take me through this. So we've got cash, fixed interest, property, shares. What next after shares? Let's say you're looking for even more. You need a bigger hit.
Well, Well, the biggest hit would be putting all your money onto in one company in the market, for
Specific
example.
Shares.
Directly, as in one or two, and taking a punt. I guess outside that, then you can go into unlisted investments. I guess investing in companies that are are going to be listed or that are looking to grow and get capital directly into it.
Yeah.
But that is longer term, and you need probably a lot more expertise and understanding
Gotcha.
around it. And I think for most New Zealanders, they don't have the time to do that. Life's noise gets in the way of those types of decisions. So I think the majority of New Zealanders diversifying their money is probably a really good core attribute, and making sure they have that buffer, medium and long term savings and investment approach will probably give them most foundation and a really good outcome at the end.
David, if people want to connect with you and find and follow what you're up to, tell us a little bit about what you're up to, because it's not just about money. Tell us about everything.
Yeah, so I love working at Mint Asset Management. We are what we call a boutique fund manager. So we have wholesale and retail clients. I do like talking, as you can probably see today, around financial well-being and capability, and bringing some of these themes that we've touched on today to life, so that New Zealanders can improve their own personal well-being and actually own it. Not necessarily being told to do it, or
why is that important, David? Yeah, to unpackage that a bit for me.
I just think that actually, people need to be responsible a bit more to their own personal circumstances. So, many cases we've been told that we have to do things like save and invest, and it's a no-brainer. But to be able to manage that yourself, I think, is important. And KiwiSave is a great foundation for that. But, people should be able to look at other ways that they want to get ahead as well.
And there should be freedom for fools to be separated from their money at the extreme.
Well, yeah.
And everything up until that point.
Yeah. Education is incredibly important. Yeah. And that's what, roles that I've been in the past are kind of been built on. At the end of the day, people's circumstances, life is not a straight line. It is very volatile, and people's circumstances change. So, they will most likely do the right thing for themselves at the time that they need to.
Yeah, we got to believe that. Yeah.
And you just have to. And, property would be an example why people invest in residential property, and they're doing that because it is actually quite beneficial over the long term. So,
it works. So you can't really knock them too much.
Yeah,
for being
it works.
Not diversified too much, because it actually works, right?
That's right.
There's balance, right?
There is balance. And I guess we need to learn from our mistakes, and we can't protect everyone around that. And that's why we have, support systems in place to help those that are not in that position financially be able to maintain an income enough to save ahead as well, which is, so hopefully that will improve in an economy perspective. The other thing, if you're alluding to the other things I love, is music, and getting into reviewing with Radio 13 that I write for, reviewing concerts. And
that was how I first kind of came across your name, I think, is that I had recently gone to a Pixies concert, and then I see this article about this from you, and I'm thinking, this guy was a money guy, but no, he's actually normal.
Yeah, no, it's important to have a few passions, and that's another one of mine.
And I love how you don't actually necessarily play any instruments, but that doesn't stop you from actually enjoying it. Which is fantastic. I totally relate to that.
Well, as a mate of mine says, without fans, you wouldn't have a music industry. So, and I'm very passionate about collecting vinyl and playing it and seeing live concerts. Cool. And taking a bit of a risk in writing about it, because when you put something out, you got to be aware that there'll be feedback whether people like it or not. But I tend to write it on the basis that who's reading is probably a fan, and they want to hear the kind of the best elements of the night.
So when is this show, and where can people find it?
So I've got this little show that I run on Planet FM 104.6 every second Saturday. I get a mate, it's called Friends to the Ends, and basically I get a buddy in, and we choose a topic of music. The last one that we did was with a good friend of mine, Mike Chun, who's CEO of Play It Strange, and we showcased students, singer-songwriters that we ran competitions for and recorded them in New Zealand studios, and that's basically our charitable trust that we help to bring to life New Zealand music through schools. So it's very cool, and the talent out there is amazing. So
New Zealand grows good musos, good writers. Just the sound is just different here.
It's great, and it's not like a breeding ground to help bring out the next kind of Lord or Kimber or someone like that. It's there to actually impart. For those that have got that focus. They don't necessarily fit into a school cool environment. They're going to be a little bit quirky. They're going to have, they may not necessarily fit in the squares and circles that we tend to have in school. So to see a student be able to, I guess, write down their thoughts, feelings, and put it to music, and then record it. And it's probably on a topic that is very heartfelt. The impact not only on the student, but also the family, to see their, their child actually
find their place in the world, right? Like
blossoming and finding a mechanism to actually get something out that's positive. Is so cool.
If they weren't expressing it there, it would come out in some other weird way.
Exactly, and it's a wonderful journey, and it's well worth a look as well.
Yeah, good on you. Keep it up, man. Well, thank you very much. And if people want to find out a little bit more about Mint Asset Management, if they have an authorized financial advisor that they're working with, that could be one of the options that could be recommended to them. But
absolutely. I mean, you can have a look on our website. We've got mintasset.co.nz. It's simple. It's got plenty of information around our funds. But we work with financial advisors predominantly that get recommended our product because it's something that they like.
Good on you. Fantastic. So thank you very much again. And thanks for listening into the NZ Everyday Investor.
Thanks, Darcy.
Cheers.